Welcome back everybody. Today we're going to do a video about dividend tax in the 2018-19 tax year. So that's a tax year running from the 6th of April 2018 to the 5th of April 2019. And let's get to it. So, should be pretty straightforward here for everyone. First, let's get into the tax rates and allowances just to set some ground rules how we work things out here. So we've got the personal allowance. This allowance here basically is tax-free. So unless your income's over £100,000, which you start to lose this personal allowance, you'll have this amount to offset against any kind of income you receive during the year, whether that's salary or dividends or interest or anything like that. So you got that as well. There's a separate interest allowance anyway, so you don't have to worry about that too much. Dividend allowance is £2,000 for this year. So that is tax-free dividends that you can receive in the year regardless of the threshold you are in. So you could get £120,000 of income elsewhere and still have £2,000 you can receive tax-free as dividends. Then we have the income tax rates here, which are 20%, 40% and 45%. So these are salary, profit from self-employment and profit from property income. And other income such as interest, once it hits over the allowable threshold, that is tax-free. So just keep that in mind. And finally, we have the dividend tax rates, which are going to be basically for dividends. So you got 7.5%, 32.5% and 38.1%. So these are the different tax thresholds, and we'll actually go into those next for you guys. Here we go, tax thresholds in 2018. Basic rate threshold, so this is keeping in mind that there is a personal allowance here from 0 to 11,850, and that's tax-free as long as you receive below £100,000 of income for the year. So 11,851 to £46,350 is the basic rate, so this will be your 20% normal income tax and your 7.5% dividend tax. Remember, the dividend allowance will fall into any of these thresholds, so you just have to work on all of your other income for the year so far. Dividends are usually taxed last, so it'll be all of your other income first and then the dividends after, and then it'll be the dividend allowance, then whatever's left over will be taxed in whichever respective threshold you are in, basically. Then we've got the higher rates threshold, which is from 46,351 to 150,000. This is your 40% tax and 32.5% tax in these thresholds. So this is, let me make this clearer. Okay, so most familiar you'll be with is salary, things like self-employment, profit, property income, things like that. So these are the rates for these thresholds, and dividends here, 7.5% basic rate and then 32.5% in the higher rate. Finally, we have the additional rate, which is £150,001 or more. So anything above this is going to be taxed at 45%, and you'll also have dividend tax of 38.1%. I have created a series of a few examples here for you guys that will basically help us work out your dividend tax for the year, and in various scenarios, so you can kind of get the hang of how it's all calculated and you don't have to be surprised when you get a tax bill later when you're filling out your self-assessment. So our first example is a higher mid-range salary, which will give us a pretty good idea of how dividends are taxed in the higher rate. So, but it's not going into the 100k threshold where you're basically losing your personal allowance and all that stuff. It's literally just 50,000 salary. So we know the higher rate threshold is £46,350. This 50,000 salary is already above that, so all of these dividends are going to be taxed in the higher rate. So all we have to do here for this calculation is take your dividends, take away the £2,000 dividend allowance, leaving you with your taxable dividend income for the year, which is £8,000. We multiply that by 32.5%. to arrive at our final figure of £2,600 worth of dividend tax. So, if you were getting a salary in the higher rate threshold already, you're already a higher earner, Usually you already have to complete self-assessment, so it's not going to be such a big deal. And then you receive £10,000 of dividends for the year, and you're going to get a dividend tax bill at the end of £2,600 for those extra dividends. Now there might be some like rounding differences with the tax on your salary. It often happens just because of payroll software and stuff like that. So you can expect a bill of £2,600 for these £10,000 worth of dividends. Now, the only thing to keep in mind is because of this bill, you'll actually have to do payments on account with HMRC. And I'll get into this a bit later, but basically you have to pay another £2,600 for the next year because HMRC will estimate your tax liability and will ask for half of the payment with your actual liability in January and the second half in July. So just keep in mind, this is not the final bill. If your tax bill's over £1,000, then you'll have payments on account most likely. Alright, so for our second example, we are looking at a low amount of salary and a high amount of dividends, and this is most likely for limited company setups. So just like single director thing, you got your lower amount of salary, or two directors, sorry, and you've got a lot of dividends to pay out. And in this scenario, we have to not only keep in mind the higher rate threshold, which is 46,350, we also have to keep in mind your personal allowance of 11,850. And that's because the salary is actually less than the personal allowance. So now that we've got these allowances established, what we've got here is £1,850 that can actually be used towards your dividends as a tax-free amount. And not only that, but we have the dividend allowance of £2,000. So this is our tax-free dividends here. And then the next step will be to work out how many of these dividends are actually going to be taxed in the lower rate. So what we do then is simply deduct. So we'll take the 46,350 minus the 10,000 salary, leaves us with 36,350 remaining dividends in the lower rate. So this is the amount of dividends we're taking into account in the lower rate threshold. We need to subtract the remainder of our personal allowance, which is the 1,850, yep. And also the £2,000 dividend allowance, which is tax-free. So once we take those two out of it, we've got £32,500 left. And this will be taxed in lower rate at 7.5%. The tax on this is £2,437.50p. But so now that we've worked out the lower rate tax here, so I'll put lower / basic rate, and we need to work out the dividends in the higher rate, because as you know, we've only used up this amount of dividends in our calculation so far. So how we work out the rest? Well, it's just the difference between 40,000 and 36,350, which is £3,650. So on £3,650 at 32.5% tax, we get 1186.25. And then all we have to do is add the lower rate tax to get our grand total of £3,623.75. So this is our grand total tax amount on those £40,000 of dividends, and remember the payments on account for this as well, because they will happen on this tax bill. And again, I will explain them a little bit later in the video in more detail. So our final example here is for £140,000 worth of income. At this level of income, you will not have a personal allowance whatsoever, because after about 120k, it's pretty much gone. It goes down by percentage between 100,000 and 120,000, and at 140, there's nothing left. So what will happen is you've already paid your regular tax on this salary here, and you're gonna have to pay actually a lot more tax because you've lost your personal allowance from these extra dividends. And I'm not gonna go into that in this particular example. I believe I did it in my other video for last year. You can have a look at that if you're interested. But basically, yeah, you're going to have an extra tax bill on your salary, not only your dividends, because of the level of income here. And if we just look at the dividends, we know that this is already in the higher rate. It hasn't reached the upper rate threshold where the dividend tax changes again. So all we need to do here in this scenario is take the £80,000 of dividends, take away the £2,000 allowance, and this final figure will be taxed at 32.5%, which is £25,350 in dividend tax. So as you can see, it's not the greatest rate of tax in this threshold. So yeah, high earners, unfortunately, you're just gonna have a lot more tax to pay. Keep that in mind. You're gonna have a big tax bill with this kind of setup, and it's not the smartest setup if you can help it. Just kind of avoid this situation if you can. All right, and finally, payments on account. Like I said, I was going to mention these later. So if your tax bill exceeds £1,000 on your self-assessment, you're going to have a payment on account to make to HMRC. What they do is estimate the same liability for the next year, so the one coming up. And as you know, the tax year runs to the end of April 2019. So your liability is due in January 2020. So 31st of January 2020 is the deadline that you must pay your tax bill. And what HMRC does is estimate the liability for the following year, so the 1920 tax year ending in April 2020, which is only about a few months after the January 2020 deadline. HMRC estimates same liability, so they want you to pay basically 50% of the liability for the following year with your payment by the 31st January 2020. So it's like a prepayment for next year. But the year ends in April, so you're only paying it a few months in advance. They just don't want to let you wait until the following January again to pay them. So that's why they do this. They just basically want their money sooner. They're a little bit greedy in that way. So they'll do the first 50% payment with your actual liability by the 31st of January 2020, and then they'll do the second 50% payment by the 31st of July 2020. So the result is to pay the tax as the year ends rather than 9 months later. The first payment on account is the most awkward. So if you've got income like from dividends and you're usually paying over £1,000 on your tax bills, it'll actually work itself out over time where you pay the 31st January deadline and then the July deadline with just differencing balancing payments in between, because you were already prepaid tax for the following year. So when you do your self-assessment, then you'll be either do a refund or you'll have a little bit more to pay plus payments on accounts for next year, so that it won't be such a big chunk. It's only the first ones that are usually such a big chunk of tax, because you're paying twice basically in a very short time span. And you can request to reduce your payments on account, but be careful with this, because if HMRC finds out that you actually had to pay more than you thought you did, then they're going to charge interest on any amount that is technically late to them. And I understand how ridiculous that sounds, because it's a prepayment. How can it be late? Well, to them it's late. They're going to charge you interest on that. So be careful when you're reducing your payments. Be 100% sure what you're going to earn for the next year if you're going to do it. And that's pretty much it for the UK dividend tax rates for 2018 and 2019, which is April 2018 to April 2019. So that's the dividend tax rates. That's how you could work out your tax for the year and get a good estimate of what your tax is going to be in this tax year. So with self-assessment season coming to an end this April 2019, you'll be able to know what to pay well in advance of the January deadline. And yeah, if you already had payments on account from last year that you made for this year, then they will be deducted from any tax you owe. So you've already paid partially for the year if you had payments on accounts last year. So that's kind of how it works. If you've got any questions at all, please feel free to leave them in the comment section below or contact us through our website. I will pin a comment on the video so you can contact us easily. And yeah, we'll try to get back to you as soon as we can with the help. So hope you all have an amazing day, and we will see you again in another video.